The share market in India, like any other market, experiences ups and downs due to a variety of factors. Here are the top 20 reasons that can cause a downfall in the Indian stock market. 1. Global economic slowdown. A slowdown in major economies like the USA, China, or the Eurozone can impact Indian markets by reducing exports, foreign investments, and overall economic confidence. 2. Rising interest rates. When the Reserve Bank of India, RBI, increases interest rates to control inflation, borrowing becomes expensive. This reduces corporate profits and discourages investors, leading to a market decline. 3. High inflation. Rising prices increase input costs for companies, reducing their profitability. Persistent high inflation also affects consumer spending and corporate earnings. 4. Foreign institutional investor, FII, outflows. When FIIs withdraw their investments due to better opportunities elsewhere or risk aversion, it leads to heavy selling in the Indian market, dragging it down. 5. Geopolitical tensions. Conflicts like border tensions, international wars, e.g., Russia-Ukraine, or trade wars impact global supply chains and create uncertainty in the market. 6. Policy and regulatory changes. Sudden or unfavorable changes in government policies, such as taxation on capital gains, sector-specific regulations, or environmental laws, can impact investor sentiment. 7. Weak corporate earnings. If major companies report poor quarterly results, it weakens market confidence. Consistent underperformance in key sectors, banking, IT, etc., affects the overall index. 8. Currency depreciation. When the Indian rupee weakens against the US dollar, it increases the cost of imports, oil, technology, which hurts corporate profits and raises inflation concerns. 9. Global market sell-off. A downturn in major global indices, Dow Jones, Nasdaq, FTSE, due to economic or political crises can trigger a spillover effect in the Indian market. 10. Liquidity crunch. When there is limited liquidity in the banking system, companies face borrowing difficulties, and investors withdraw from equity markets, causing a decline. 11. COVID-19 and health crises. Pandemics or large-scale health emergencies disrupt economic activity, reduce consumer demand, and create uncertainty in financial markets. 12. Political instability. Uncertainty about government stability, coalition issues, or elections can reduce investor confidence and lead to a stock market decline. 13. Weak economic indicators. Negative trends in GDP growth, industrial output, employment rates, or other macroeconomic indicators can trigger a market sell-off. 14. Corporate scandals and governance issues. Fraud, mismanagement, or governance lapses in large corporations, e.g., Satyam scam, erode investor trust and lead to panic selling. 15. High oil prices. India imports a significant portion of its oil. Rising crude oil prices increase input costs, fuel inflation, and negatively impact industries like aviation and logistics. 16. Market speculation and panic selling. Rumors, false news, and panic-driven selling often exaggerate short-term declines as retail investors follow herd behavior during uncertain times. 17. Rising fiscal deficit. A widening fiscal deficit, government borrowing more than it earns, weakens the economy's long-term outlook and impacts market sentiment. 18. Global credit rating, downgrade. If credit rating agencies, Moody's, S&P, downgrade India's sovereign rating, it affects foreign investment inflows and increases borrowing costs. 19. Natural disasters and climate events. Earthquakes, floods, or other natural disasters disrupt industries, supply chains, and consumer demand, causing temporary market shocks. 20. Technological disruption and cyber threats. Major technological failures, hacking incidents, or large-scale cyber attacks on financial institutions can lead to a temporary market sell-off. Stock market movements are influenced by a combination of domestic and global factors. While downturns are part of the investment cycle, maintaining a long-term perspective and staying informed helps investors navigate market volatility effectively.